In this topic, we're going to have a look at a concept called the Boston Matrix. It's another key marketing topic for the A-level business syllabus. And the Boston Matrix is a way of allowing managers to analyse what's known as their product portfolios, the range of products that the business that they work for sells. So, very few organisations are what we call a single product firm, where they only have one product that they sell to customers. Most are what we refer to as multi-product firms, so they sell a range or a portfolio of different goods and services. Now, some of these goods and services can be in a diverse variety of markets, and managing a portfolio with such breadth and diversity to it can be a particularly challenging task. One of the big challenges can also be deciding when new products should be added to a business's product portfolio. So the Boston Matrix is a tool that helps managers with these planning dilemmas of deciding whether they've got a strong product portfolio and whether new products need to be added. So to understand how the Boston Matrix works, a good idea is to take a little look at the axes and understand how the Boston Matrix breaks the kind of products that a business might have in its portfolio into 4 different categories. So we can break a business's products up according to, first of all, whether they have a low market share of the market that that product is active in, or whether they have a comparatively large market share. The other way we can break a business's products into categories is to whether the markets that those products are in, whether they are fast, rapidly high growth markets. So whether those products are in markets that are experiencing a high rapid growth rate, so sales per week, per month, per year are growing quite rapidly, or whether the business finds that it's got products in markets that are quite slow growing, so they have low growth rates in those markets, which might sound like those are less desirable markets to be in, but that would be a little bit of a falsehood. Low growth markets may be markets that have already matured, they've already done their growing. So low growth markets could be things like the automobile market. So if you imagine that you are selling cars in the automobile market, that's not a market that's growing particularly fast, but it is a market that's already very mature, very, very strong, and there are great profits to be made in that market. So we can split our products into 4 different categories. Namely, we can split them into categories where we describe them as either question marks or problem children. We might describe them as stars, we might describe them as cash cows, or we might describe them as dogs. So we'll start with question marks or problem children. These are products that have a low market share, but they are in markets that are growing very rapidly. So these are dynamic, fastly evolving markets, quite exciting markets for the firm to be active in. But the question mark attached to them is that our firm currently only has a small market share in that market. Now, that means that from the point of view of managers, these products provide a little bit of a dilemma, because we might have to invest quite heavily in marketing these products in order to try and grow their market share, which could make them a little bit of a problem. It might mean that there are question marks attached to them because we're investing lots and lots in this product because we're trying to expand its market share, and we really want this product to be a success because it's in a market that is growing very, very rapidly. But we may have to commit to spending far more supporting this product than it's actually generating for us through sales, which means that there's a question mark attached to it. Next type of product we might have are what we call our star products. These are products that have a higher market share this time, and they're still in those rapidly developing high growth markets. Now, these products are exciting. The business will find that these are products that they're really trying to support, really trying to invest in, because as this market continues to develop and carries on growing and starts to mature, if we can maintain that high market share in this market, then we are going to have a very lucrative, very profitable product in our portfolio. But we might still be spending a lot of money on this product because as this market is growing and developing, we're having to really fight to maintain our high market share. We don't want that to erode at all. So even with stars, we might, with some of our stars, be investing more into them than they are making in sales revenue. But some of our stars, especially as those markets are really starting to mature, will be making profits for our organisation. Now, the other reason why question marks and stars can be a little bit of a dilemma for managers is because we're not the only firm that are going to be attracted to the high rates of growth in that market. So the competition in these markets can be incredibly intense as new entrants are trying to join this growing market and they want a slice of the sales that are up for grabs in this market. It just makes them a competitive environment in which to be. Our next type of classification of product is what we refer to as a cash cow. So cash cows are products that are in slow growing markets. They're in markets that have already evolved, already developed, already reached their maturity, but we have a large market share in these markets. So think of an electronics product, perhaps like widescreen televisions. The rate of growth in these markets is not very large, but they've already grown. They're already huge markets. The number of widescreen TV sets sold this year might not be an awful lot greater than last year, but it will be a massive number. And if we've got a big market share in that market, we are going to be generating very high returns from the products we have in those industries. Now, they get their names cash cows because we are meant to be able to milk these products for their profits and use those profits to distribute towards other products in our portfolio that may require some support and some nurturing. Our final classification of products is what we refer to as dogs, which on the face of it sound quite undesirable products to have in your portfolio. They've got a low market share of markets that are not growing very rapidly anymore. However, that's not to say that these aren't products that we might still be deriving some profits from. If we've got products in markets that are already mature, and those are very large markets with high volumes of sales that aren't growing rapidly, but the volumes are still high, even having a small market share of such a market might be generating significant sales for the organisation. So dogs are not necessarily as bad as their classification might suggest. But again, they do need some thought behind them, particularly during times of economic hardship where we might not be able to commit to continue to supporting a product that's got dwindling market share in a market that has had its day and finished its growth. We might think about withdrawing such products from the market. One thing we can do is probably link the Boston Matrix to another concept that we've learned about, and we'll link to a video to it down in the description below for our one on product life cycles, because there are kind of broad comparisons we can draw between the two. It might be that we can link different factions of the Boston Matrix to our stages of the product life cycle. So your dogs quite classically would be products that have reached the decline stage of their life cycle. So their sales have started to tail off, their sales have started to dwindle and decline, but we know from studying the product life cycle that those are the products we might launch extension strategies for, and it's the same for our dogs. So it might be with a change to our marketing and a little bit of investment behind it, we can start to grow the sales of this product once more. Our question marks, our problem children, we could classically link to products that are at the introduction stage of their product life cycle. So unless we're launching a product that has some hype or has some preliminary marketing behind it, so the market is anticipating this product, it's waiting for it. Maybe we're launching a more updated version of a product that's been popular in the past. Unless we're launching a product like that, it's probably going to start as a question mark. It's probably going to have quite a small market share when it's first launched, just like a product would in the launch phase of its product life cycle. Our stars are more classically associated with the growth phase of the life cycle. So as we start to grow our sales, we're building up that market share, and so there's alignments between growth and stars. And our friends, the cash cows down the bottom, would typically be in the maturity stage of their product life cycle. So their sales have grown and reached their peak. They're at the maturity stage where they're absolutely maximizing their sales, and we are milking as much profits from those products as possible. Now, the other things we can tell you about the product portfolio analysis, or the tool of the Boston Matrix, is what it is useful for. And it's a great tool for managers for assessing the overall balance of the product portfolios of their organizations. Because although it might seem on the face of it that the best type of product to have is a cash cow, you don't actually want a product portfolio that is too unbalanced in any of the categories. Having a portfolio that's just stuffed with cash cows is very, very lucrative, but it does present problems for the organisation. Because again, if we link it to the product life cycle, if all of those cash cows mature and move into the decline phases of their life cycles in quick succession, and we don't have any products like question marks and stars coming through to replace them, an organisation can find that a product portfolio that looked very lucrative and was full of cash cows quickly becomes an old people's home and is full of dogs. So the idea with the Boston Matrix is to try and analyse whether your portfolio is balanced or not. Yes, you want a healthy number of cash cows that you're using to generate high returns, but you're using some of those returns to support products that are in other classifications of the matrix. So you can use the profits from the cash cow to help nurture and support those question marks and build their market share and turn them into stars. Those stars whose markets are growing so fast, you use some of the money from the cash cows to nurture them further. Make sure those market shares stay high as that market reaches maturity. And even with the dogs, which may be generating profits for you, you use some of those profits potentially to do some extension strategies with other dogs in your portfolio in order to generate as much sales as you can. So it may on the face of it look like having cash cows is the best product to have, and certainly in the short term they are the ones that derive the greatest financial rewards for the organisation, and you can use those to pump high dividends out to your shareholders. But if we're looking at the long-term health and viability of the organisation, a balanced portfolio with a roughly even number of products in each of the classifications of the matrix means that the business has a portfolio that is more sustainable. Now that really brings us on to the second use of the Boston Matrix, and that's to do with planning when new products might need to be launched. So if a business does some product portfolio analysis and notices that it does have a portfolio that's a little bit unbalanced and maybe is favouring having more cash cows and dogs than other products in the matrix, it just acts as that catalyst for managers thinking about perhaps using some of these profits for some new product development, for doing some R&D, for getting the market research underway, because we need to launch some new products to balance out our portfolio and make sure that we have some longevity to the portfolio of products that we are offering to market. So that gives you a quick rundown of the Boston Matrix, a great concept for the A-level marketing syllabus. If you have any questions about the Boston Matrix or any other business topics, feel free to throw them in the comments section below, and somebody from the Taking the Biz community will be able to answer your questions. Until next time though, the very best of luck with your ongoing revision, and we will see you soon.